Good morning. If you stragglers want to grab a seat, we are about to hit one of the hot topics of 2019, right?
Absolutely.
Yeah.
The shiny new penny.
Our shiny new penny topic. Yes, this is the Opportunity Zone session. If you don't want to be here, get out now. The doors are closing. I'm Rebecca Peace. Most of you probably know me. And I am going to quickly pass the mic along to my friends up here on the panel who I've invited to talk to you about this topic, which is a brand new tax incentive that came out of the 2017 midnight hours of December, when all of us were scrambling, trying to figure out how we were going to solve affordable housing issues, when the tax code was up in a great disarray, and there was lots and lots of stuff going on, and they passed this bill, and this sleuth, kind of this stealth thing came in, which was called Opportunity Zones. We're going to talk about that today. First of all, some housekeeping stuff. This session here is being taped. So if any of you don't want your mugs on, put a bag over your head right now or get out. Okay, that's it. That's your disclaimer. So I hope you don't mind. That means, though, that there's only one mic, and that's the one I'm holding, as well as the mic that they have up here. So if you do have a question, please ask it clearly and loudly. You can shout it out, pass it up, use the tin can theory up the wall. And we'll try to make sure that that question is accurately articulated for the entire audience and for the tape coming in the future. So if you ever want to hear what these guys said that was brilliant, go back and look at the tape in the future. My panelists today are Richard Barnhart, who I've known for over 30 years. Yes, I know, that's scary. Our 3 decades together. Mostly good, mostly good.
Met in grade school.
We did, pretty much. Richard's from Pennrose, and I'm sure a lot of you know that Pennrose is an enormous leader in affordable housing, both here, regionally. They do a lot of national stuff. So thanks, Richard, for agreeing to come in and give some insight into how you're here. Molly Bryson is a partner from Ballard, Spahr, and Molly is very versatile in lots and lots of tax credit types of programs, including new markets. She's stepped right up to learn the regs, and she's over-impressing me because she brought the regs with her today. Just telling you. If anybody has a question about a particular subsection, she's got you covered.
Absolutely.
And Mike Ross, who I've had the pleasure to work with for a number of years from Baker Tilly. He's an extraordinary expert in a number of tax credit programs as well. Thank you all for agreeing to be here. I want to know who you guys are. So, how many of you are housing developers extraordinary that want to know about opportunity zones because you got lots of money in your pocket? Hands up? Okay. How about you don't have that much money in your pocket, but you still are a housing developer and you want to learn about this? There you go. Now I got you. How many of you are lawyers who just are curious because you're junkies? Yeah, okay. I got you covered, guys. How many of you are actually working actively to formulate a fund, an opportunity zone fund, an investment program? Oh, I thought some of you might be in the room and I could do like fly paper later on. We could hook you up. How many of you are accountants that are just curious about this particular? Yeah, there you go. Got a couple of you. Also junkies, great. Anybody else you guys want to know about? That's your audience today. Okay. I am going to pass the mic over to my buddies here, and I think Mike and Molly are going to hit you off and enjoy the session.
Thanks, Brian.
This is on.
Okay.
Thanks, Rebecca. First, I want to just explain, kind of how we're going to approach this. So Molly and I are going to go through the technical aspects of it at a very high level, and then we're going to turn it over to Richard to talk about his real-life experience from the practical. And then we have another part of the presentation that we may get to, which goes into a little bit more deep regulations. And there were some new regulations that were released last week, and we are able to talk about that, but at some level, we might not want to, given the time that we have and the detail that a lot of rabbit holes we might go down. So with that, we're going to start a little bit about the opportunity zones. Again, Mike Ross from Baker Tilly. I wanted to explain a little bit about our approach. We are a CPA consulting firm, but we're also an investment bank. And as an investment bank, we are working with sponsors of projects, and we're looking to underwrite them and actually solicit investors from our client base and others for opportunity zone transactions. We have our first transaction on the street, and it's being well received, and we're looking forward to seeing how the market evolves. I'll let Molly talk a little bit more about herself later. So opportunity zones, what they are actually it's a subset of new market tax credit zones. And I've been working in new market tax credit zones since the beginning of the program, and new markets have been relatively successful in their objective. And their objective was to attract an interest in investing in low-income communities. About 5 years ago or something, there was this idea that, hey, there's all these capital gains in the marketplace that people are sitting on, especially in the tech world. So what if we put some of those capital gains at work in these low-income communities and do some additional investing that new markets isn't able to do because of its limited resource. I think they determined that there's $6 trillion of unrealized capital gains that are potentially available to come into potentially low-income communities. And what they did was they basically created a part of the code for opportunity zones. This opportunity zone code is not a program. It's not a traditional gap financing from an economic development tool. It is a tool that's available to taxpayers to defer tax. And it gives them an incentive to invest in low-income communities. They don't have to work with anybody from government in order to participate in this program. It's between them and the IRS. So it's not a traditional tool that a lot of economic developers are looking, that's available to them. They were designated by the governors of each state, and there's a map, and you can type in Baker Tilly Opportunity Zone map, and you'll get to a map. You can type, there's other mapping programs as well, and if you put in the address will tell you whether it's an opportunity zone. It's that simple. If you're in an opportunity zone, you then have that tool available in putting together your project. The program has three primary elements to it. One, if you have a capital gain, we'll get into more details on what that is, but it has to be a capital gain. It could be selling a building, could be selling art, but it has to be considered a capital gain. And that is generally, and it can be from a corporation, a partnership, an individual. They have to have a capital gain, and then they can defer the tax on that capital gain until 2026. And it's just a date and time. It doesn't change. It's just, that's the date. So if we do it 2 years from now, they still got it, they'll have less time to defer. So they get that deferral. So they can pull money out of the stock market or whatever and invest it in a qualifying opportunity zone fund. They don't have to pay the tax for until 2026. This is particularly attractive if you had a short-term capital gain. So you had a capital gain of $1 million, and you were in the highest tax bracket, and you had to pay 40% of that to the government. So you got $400,000 goes out of your checkbook from that $1 million gain, goes to the government. So the idea is if I invest the full $1 million, I can make money as an investor on the 400 I would have paid the government. So that's the primary component of that. The second part is if you hold the investment in the fund for 5 or 7 years, you'll get a discount on the tax. And the tax will be at the tax rate at the time. So if tax rates are a lot higher, you're going to pay it a lot higher. But that is also mitigated from the potential forgiveness on tax depreciation, and we can get into detail there. But there is a real value of, on that $1 million gain, it was short term, and I had a $400,000 tax on it. If I don't have to pay 10% of that, if I hold it in a fund for 5 years, that's some real savings. Again, this is in 2026 is when the tax gets paid, and we can get into the 15% in a little bit here, but there is a partial forgiveness of the tax. And the real value, in my view, is that if you invest in this program and it's qualified and you hold your investment for 10 years, you can get tax-free appreciation. And that tax-free appreciation will go all the way, if you want, to 2047. So this doesn't only work for real estate, it also works for business. So if you invest in the next Facebook or whatever, and it qualifies, and they meet all the rules, and that thing grows, exponentially for 15 years, that's a huge savings. Real estate is very attractive as well. Obviously they're not making any more of it, and that has generally gone up over time, and that tax-free appreciation would be very valuable. With that, I'm going to have Molly go through a little bit more technical aspects, and I will chime in on some thoughts as we go.
And of course, we wouldn't stop Richard from chiming in as well, but we'll see how that goes. Molly Bryson from Ballard, Spahr. But before I sort of dig a little bit deeper into these benefits, just to provide context, right? And those of you that were at the panel yesterday may have already heard my little teaser. But this is an amazing speed that we are trying to get a program up and running and actually do deals. And when you think about it, December of 2017 seems like it was a long, long time ago, but it was only a year and a half ago, right? And during that period of time, what's happened, and it's been a great coordination with, I think, the federal government as well as the states, right? Each of the states had to designate their zones, and then Treasury approved them. And that process didn't finish with all of the states, DC, and the possessions until June of 2018. And then, we had last summer some FAQs from the IRS that were interesting, but, not very detailed. And it wasn't until October of 2018 that we got our first set of proposed Treasury regulations that shed some light on this program and what this statute, which is in, two sections of the code, the tax code, is really meant to mean. So then, fast forward, we're waiting anxiously for the second set of guidance, which, as we'll talk about a little bit, just came a couple weeks ago in April. During that period of time, there's been a lot of interest. So the White House has a council that's specifically entrusted with trying to make this program work, headed by Secretary Carson. So HUD has been very involved, and HUD just recently sent out a request for information for people to write in as to how can HUD potentially help make the Opportunity Zone program that much more useful. You have, in this sort of Treasury process, people writing in with comments to Treasury, and that's still going on. There was a public hearing on the first set of regs on Valentine's Day. There'll be another public hearing on the second set of regs in June. So it's a very fluid process, and we'll tell you what the rules are today and what the implications are today, but I can promise you that we'll have a different idea in about 6 months, right? Because this is really, really evolving, and that's the great part about it, but that's also the bad news, because it's really hard, particularly when we're thinking about real estate development, which, as we all know, takes a really long time leading up and based on certain assumptions, and it's hard to change course. But I think we all have to be very nimble for those of us that are interested in figuring out, can this additional source of equity work in my capital stack to make my project that much stronger or better. So that's sort of a little bit of the context. And I think as we talk about these rules and we talk about sort of what the interpretations are and how they can be used today, I think the caveat will always be, that could change, right? And there's also, I think as of this week, there was proposed legislation introduced in the Senate, by Senators Booker and Scott, who are, of course, behind the original legislation, from South Carolina and New Jersey, or the reverse order, to provide reporting requirements. Because right now, there are no specific reporting requirements as to, what this investment in capital is really going to yield. So from my perspective, that's going to be really interesting. And there's a whole slew of data that, if this is passed, would be expected to be collected. And I think those of us on the community development side that are really interested in using this news source are very, I think favorably welcoming that, because that is an additional piece of accountability, right? And then, this is a great tax benefit, not a tax credit, but a tax benefit to people who, and that has broadened, I think, the social capital, the socially minded investor to think about projects that include affordable housing, but at the same time, there's no current requirement that it has to do any good, right? But soon, hopefully, that will be very specific, and there will be data points that will need to be collected in terms of, monitoring, how is this up to $6 trillion of potential investment, right? And even if we capture a bit of that, that's still a big number. How is that doing good in our communities? So that's more of the fun. Now I'll dig in a little bit more into the detail about why this isn't a tax credit, but a tax benefit. And from my perspective, it's all about the time value of money, right? If you have to pay the tax today, you don't want to. You want to put it off. So why not do that? And I think this program, while as Mike said, there's no sort of government involvement per se, but it is super, super technical. And it seems, I think, deceptively simple. And as we continue to get additional guidance from the IRS, a lot of things are very taxpayer friendly, quite frankly. And I think the Treasury in public statements has really been out there trying to say, look, we understand, we want to make this work, we want to give people enough information that they can take this and actually use it, and use it in a way that actually is helpful for real estate development as well as operating businesses. But at the same time, I think what's happening is that the more and more rules, is making it really, really complicated. So that said, as Mike alluded to, this is patient capital. So the biggest benefit is if you have the capital gain, you invest it in a qualified opportunity fund within 180 days of that gain. And even that, there are some exceptions with respect to if you got the gain as a partnership and some other exceptions. But the general rule, if you're putting capital into a qualified opportunity fund within 180 days, and then you keep that interest, you keep that capital, and if you hold it for 5 years, you get a benefit. If you hold it for 7 years, and that happens to occur before December 31st, 2026, you get a greater benefit. And then if you continue to hold it for 10 years, you get a different benefit. Because the benefit, if you hold it for 7 years before 2026, for those of us math whizzes out there, Richard, right, that means that by December 31st, 2019, which is quickly approaching, you would have to make that investment. And I think there's a lot of speculation, right, that really is going to, tied with these new regulations, really spur a lot of additional investment between now and the end of the year. Because unless Congress extends that 2026 deadline when all the tax comes due, you want to have your, QOF investor wants to be in the QOF by the end of this year. So that's really not a lot of time. And the benefit to that is when the tax comes due, instead of paying the tax on the full capital gains amount, you get to pay tax on, 15, assuming that it's, well, let me give you an example. If your capital gains was $1 million, you put $1 million into a qualified opportunity fund. If you're holding it for 7 years before 12/31/2026, at that time, instead of paying tax on the $1 million, you're going to pay tax on $850,000. So that's a great benefit. Not only have you had the time value of money, you haven't paid tax over that 7 years, but when you do pay tax, you're paying tax on a lower amount. And that really is sort of the first one. But it doesn't mean that if you miss the 2019 sort of soft deadline and you don't invest until, say, next year, you'll still have held it for at least 5 years before 2026. So that means that instead of paying $1 million on that investment, you're going to be looking at paying tax on $900,000. So still a benefit, right? It's still less than what you would have paid, and you're deferring payment, until sometime in the future. So that's all very helpful. What I think a lot of people get confused about is that if you're holding it then for a total of 10 years, you don't look at the tax on the original capital gain, you're looking on the appreciation, as Mike was saying, if you had, say, Apple stock, or if, your real estate project, right? You're looking at the appreciation of when you became a QOF investor and what that asset value was worth versus what it was worth at the end of 10 years or when you go to sell it. And so that presumably could be where the rates of return, and Mike has a great model to show this, really sort of spikes up for, appreciating property. We'll talk a little bit about, how big of a boost is that for, say, restricted property, affordable housing. But in any event, I think the theory is that, that really will be a benefit to the investor and want them to, put that capital in. What do I do? Sorry. Okay. Okay. So what qualifies long-term capital gain, short-term capital gain? I think the rules are really complicated in terms of gain from the sale of real estate. I spent an hour actually this morning talking about that very question to about a situation where a real estate developer was doing a mixed income project, already had the property, wanted to transfer it, sell it to a new entity, and sort of what is that capital gain on that sale treated as, and when do you get to know it? So I would say that those rules are rather complicated, and the so-called 1231 gains, and sort of from the your gain from the sale of real estate, and when you recognize that, and when you can put it into the deal and be eligible for QOF benefits gets pretty technical. Yep. Okay. We'll leave that there. Let's see. There was clarification that even though the qualified opportunity zones are in effect until 2028, you can still hold your investment up through 2047 as long as you get into the QOF, you get into the QOF before 2026, you have that period of time. I think there was a lot of confusion initially, as if the zones, sort of end, then what does that do to the investment? So the IRS had clarified that. I will say that there's some misinformation I've heard on some panels that says that the census tract information is based on the 2010 census. I know that census information in terms of what qualifies as a qualified opportunity zone was based on later information that had been updated. So, as we'll go, many of these opportunity zones are distressed. Many of them are somewhat distressed, and many of them you might think that, you don't see a lot of distress. And I think that's what's led people to say, sort of, when you're thinking about where the capital is going and the really tough questions of gentrification, sort of, how does that play out? And for example, I think 8 of our offices are in qualified opportunity zones, so it's sort of interesting, and our offices are generally in downtown areas, so but food for thought. But if you're contemplating this as a potential play for you, the first thing you do is to find out if you are in the zone. And I think, as we'll talk about, that can have implications if you just want to hold on to the property, if you want to sell it, or if you want to do something, since that seems to be very hyped up in sort of the real estate market. Like I said, if the gain comes from a partnership, there's special rules, but we'll go straight to the pretty chart.
Yes.
You want to take the lead on that, or you want me to?
Well, actually, just going back to the partnership thing, it does help with the timing. So if you sold an asset in a partnership on January 2nd, that gain will come through, assuming it's a calendar year, it'll come through on a K-1 that gets, produced for the calendar year through 12/31 of that year. So you, as a taxpayer, can elect to actually have your 180 days start on that 12/31 date. So you'll have till June of the next year. So you almost have like 18 months to invest the capital gain. Because quite frankly, the gain's going to be coming. And the partnership can elect to do the gain and invest it themselves, which A lot of situations, that's probably not going to happen because it's not like a 1031 trade where you have to do all this like-kind exchange. You can do any dollar amount. You don't have to do the full amount of the gain. So if you have a partnership with many people in it, I think the partnerships won't decide to do it themselves. I think they'll let the individual partners decide to do it. And if the partnership files a short year return, well, then you got the 180 days after that. So my point is that you potentially have a lot more than 180 days. And a savvy investor in the stock market might actually put their stocks in an entity that comes out of a K1, so then they have more time. But the timing is, that's important. The other thing is, when you get the gain as an individual, you have to fund a fund. Well, you can form your own fund. You don't have to put it into any particular fund. So that gives you more time as well, because you can just self-certify a fund.
Right, so one of the elephants in the room, and there are probably a number of them, but one of them is with this program, the timing is pretty unforgiving. However, we have gotten some relief, and as Mike was saying, one of the areas of relief is on that 180 days. But you've got this requirement that the investor who's got this money, they're putting it in, and it doesn't have to be traced. So if there's a capital gain of $3 million, but you have $3 million already sitting in the bank account, you can take it from there. It doesn't have to be directly taken from, so that's helpful. But you've got your clock starting. So I know we don't have any fund managers in the room, at least not, they weren't here in the beginning, but the real trick was, you're trying to find these investors that want this tax benefit. They're on a clock. And then you're also trying to find these properties that work, that fit all of these requirements that we'll run through at the same time. And there's requirements for the investor to become a member of the Qualified Opportunity Fund, which is either a partnership, a limited liability company, or a corporation. And then you've got the timing of when that Qualified Opportunity Fund either drops down the money, and here you can do it two ways, either directly into the Qualified Opportunity Zone business property, which is the center column, or indirectly, that Qualified Opportunity Fund can become a member of a limited liability company, it can become a partner in a partnership, or it can become, own stock in a company that then owns the underlying real estate asset. So either way, and we'll talk, there's pluses and minuses to both, but ever since Treasury came out with a working capital safe harbor, because the other elephant in the room is that this program is not about hoarding cash. It's about put the cash in and use it. And so the trick is with any real estate development, you're using cash over a period of time, right? You might have a 12-month, 18-month, it might be longer in terms of the actual construction schedule, but you're probably going to have a lead up to that as well. And it's trying to sync those two requirements that I think is so challenging. But even though I'm talking about a lot of elephants, I do feel that this program is very positive, and I am a true believer, so let me just say that, even though I think it's really tricky to sort of put this together. But as Mike said, it is deceptively simple. Like, anyone can form a Qualified Opportunity Fund, right? Today, I can, file an LLC with the Delaware, Secretary of State and get it same day. And then you can have, if, Richard wants to be an investor, he can put his money into my QOF today. And then there we go, we're off to the races. And the requirement is that there's a new IRS form, 8996. So any lottery players out there maybe want to start using that number. I don't know, but it seems like a good number. But, you file that form, then if we did it today, we would file that form with our taxes, next spring. So that's sort of basic. And then in my example, my QOF is an LLC, so the operating agreement I'm going to put together needs to say in its purpose that, it is for investing in Qualified Opportunity Zone, property. And so there's some question as to how detailed it needs to be. Quite frankly, but generally the rule is the more detailed you can be, the better. But as we've said, a lot of funds want to form. They don't quite know exactly what they're going to invest in, but they might have a sense of the region. They might have a sense of the asset class. Maybe they do want to invest in affordable housing broadly, or affordable housing, workforce housing, and the like. And if you can say that, so much the better. And then the third test of being a qualified opportunity fund is that it has to meet what's called a 90% asset test, which is that 90% of this QOF, its assets, has to be either in qualified opportunity zone stock, qualified opportunity zone partnership interest, or qualified opportunity zone business property, which is the underlying asset. And so that test is measured twice a year. It's an average of 2 times, the end of the first 6-month period of the Qualified Opportunity Fund, and then 12/31 of that year. And so that is something that, it's not one and done. You have to constantly measure this for the full holding period, which for many funds will be the full 10 years to take advantage of the ultimate benefits. Any comments on qualified opportunity funds at the moment? Okay. And so what we're seeing, I would say, is that when you have a choice between having the QOF, own this qualified opportunity zone business property directly, which we'll drill down a little bit in terms of what those requirements are, or if it's a member of an LLC, or if it's, owns stock in a corporation, one of the factors that's considered is, can you take advantage of what the IRS has provided in terms of a safe harbor for working capital? And they have said that when you're using a subsidiary structure, so if you're investing, you have a indirect ownership, then you have a period of time in which to actually use that cash that comes into the business. And that, for real estate developments, is almost always the choice you choose because of that idea that you're sort of using cash. Also, we've just learned that working capital safe harbor can be applied to startups, operating businesses that are starting up that also might, need sort of cash over a period of time. And this period of time is 31 months. So it's, for those of you in the room that know about new markets tax credits, there's a sort of different reasonable working capital safe harbor requirement, which is shorter. So I'm actually personally happy that this is a longer period of time that helps perhaps bring into reality what it takes in terms of the timing for a real estate development in particular to get off the ground. Okay, so that we're going to drill down then in the blue box, right? What is qualified opportunity zone business property? These are the tests. It's a tangible property used in a trade or business. There was some question about whether residential rental property qualifies. We have gotten that question answered, that yes, in fact, it does. However, triple net leasing would not qualify. But, I think triple net leasing is a very complicated topic, and if you throw in an extra service or two, maybe you're not a true triple net lease. So I think there'll be a lot of people in the real estate sort of industry sort of focusing on that. But be that as it may, tangible property. It's property acquired after 12/31/2017 by purchase, so that has a special connotation. And then 2 things happen. Either the original use of that property in the qualified opportunity zone begins with the fund, or that fund or its subsidiary has to substantially improve that property. And that's where substantial improvement also is defined. And in the statute, which I said it was only 2 sections, right, they use the word substantial or substantially 5 times, and they hadn't defined it. The first set of proposed regs in October answered one substantially, and then this next set just recently answered the others. And when you're doing this testing as to whether you qualify and whether these businesses actually, or these real estate developments actually meet these requirements, the percentages really matter. And it is a very finely tuned test as to whether you are meeting this requirement. One of the things we've also gotten guidance on is with respect to substantial improvement. Initially, it meant that if you were going to put rehab into a building, for example, you had to put the cost of the rehab at least as much as the cost that you had paid for that property, land and building. The regs had clarified that the test for this purpose would be something less, that you could look just to the value of the building. which certainly is helpful, but as we'll talk, when we're thinking about combining qualified opportunity zones with low-income housing tax credits, that also, as you know, has a rehab test, which is, in many cases would probably be somewhat less than sort of this test. So, when we're thinking about sort of what are the issues that we would have to really work out if we want to combine them, that would be one of them. Does anyone have any questions so far?
Don't ask that. Don't even ask that. Not yet.
Any questions for Richard?
No. I promise, I have pretty pictures. Just saying.
Oh, come on.
I do have a question for Mike. You mentioned the 180 days doesn't start until the end. Is it the end of the year, or is it when the tax would have been due?
No, it's, in a partnership, assuming the partnership just sells one of its assets, not all of its assets, and assuming it's a 12/30/01 year end, it would be 12/31, 180 days from that. If a partnership only had one asset and it sold everything, and it filed a return 30 days after it sold everything, then it's, and it ceased activity, it would be, then would file a return, let's just say June 30th. So then it would be 180 days from that. So it's the 180 days after the end of the partnership, and the gain comes through as a K1, from the K1. Got it. This substantial rehab component, that's a pretty significant barrier for projects. In this example here, if you bought a building for $10 million and the land was worth $4 million, that means the building's worth $6 million. You'd have to put $6 million of rehab into it. So that's a pretty substantial barrier for substantial rehab. The benefits. So, as I indicated in the beginning, there's not a program per se. It is really a benefit to taxpayers. And what this chart is just illustrating is because you're making money on what you would have paid the government, your return's going to go up, assuming everything's the same. And this also illustrates, well, I'm going to pay the government less because of the discounts of the 10% or 15%. So that's really the premise here. And this is just illustrating an example of how you'll make more money as a developer or as a investor in a project.
Remember that chart when I get to
Yeah.
that sloping curve, two sloping curves. I'm going to
Yeah.
refer back to that.
So if you do an analysis of, the after-tax IRR, we've actually done it, and because, and the power of compounding and the power of present value, the longer you keep this investment out, you're going to have more tax-free appreciation. You're going to, make as much money as you can on the government's money before you have to pay it. So I think this assumes you invest by the end of the calendar year, you can earn substantially more money than if you took your cash, paid the tax on it, and invested in the same project. So that's what this is illustrating. And so really when you look at it, so who are the winners in all of this? Low-income communities are winners in that you're getting more interest in investing in these specific areas. Now, would they have invested anyway, or were they invested in maybe a different low-income census tract? So we don't know those unintended consequences of these specific zones, but there's certainly there's a lot of interest in investing in these census tracts. Sponsors of projects, they certainly can be winners in this because of the potential return, because people hate paying taxes. They have the potential to get larger slugs of capital for investing. They're going to have more patient investors. They might present a deal that's like normally, 10-year, pro forma and IRR, but they think they're going to get rid of it in 5 years. Well, here, the investors have to be in it for 10 years. So you're going to get more patient capital, potentially larger slugs of capital, plus, if they're going to make 45% more on their money, maybe we don't have to pay them as much as the sponsor. So they're probably willing to take a little bit less return than they otherwise would. And then the sponsors of the projects also benefit in the fact that these opportunity zone investors, if all they do is invest in this project, and they don't guarantee get debt, which they typically do not, and if you don't enter into some other things, et cetera, but you actually could, as a sponsor of the project, not offer as many of the tax attributes to those investors as you normally would. So in other words, you don't have to give them as much depreciation as you normally would give them. So like in a typical real estate deal, you give them the depreciation. Now, obviously, in a LIHTC deal, it's a different story, but a typical office building, if you're raising capital for it, and you get it's in an opportunity zone, and you get this capital from opportunity zone investors, they don't put any other capital in, they don't guarantee any debt, there's not a non-recourse mortgage, they don't have basis for taking a tax loss, so you don't need to give them depreciation. So the sponsor of the project can keep that for themselves, or maybe they can find someone who wants to invest other capital who would be interested in that depreciation. So the whole dynamic of putting deals together for a sponsor who's working in opportunity zones and working in non-opportunity zones, that dynamic should change because they have an opportunity to get more slugs of capital, more patient capital, get more tax attributes from the projects, pay them a little bit lower than normally would have to pay them. And so they might be willing to stay in a project longer than they normally would do. Everyone will get this PowerPoint, and in the back of the PowerPoint, if we don't get to it, there's a lot more technical things. And certainly Molly and I will be available if anyone has any.
This has been the non-technical.
Yeah, yes. Yeah. Again, these charges, illustrating again, the power of the investment, which I think we've got that covered. There's a very, very flexible program. It pretty much
Okay.
any type of investment other than some sin businesses.
Very true.
Yeah. Most people have been looking at it in the real estate side, not on the business side because the rules aren't quite gelled yet. I think over time there'll be a lot more interest in investing in operating businesses, but for now it's just pretty much all real estate. That's my view on it.
Mm-hmm. And different websites you can go to that have tried to compile sort of what these funds look like. And one that I've looked at was NCSHA, National Council of State Housing Agencies, and I think they have 130 sort of QOFs that are on their list. And what's interesting to me is the statistics, sort of what these look like, right? So they're and I will say, too, the caveat is that a lot of people form them. They may not have raised that money yet, right, or they're in process. But on this website, they can be sort of any amount. I think the average, based on sort of that group of data, is maybe about 200 million. But a lot of funds that I have been working with, might be 50 million, or they might be very targeted to either one project or a couple projects. We'll say these recent regs did do a lot to help with this idea of a multi-asset fund, which before wasn't necessarily that clear cut. So potentially even the makeup of these funds will change. But by far, a big chunk, as Mike is saying, of these QOFs are investing in real estate of some kind, including sort of commercial real estate, multifamily housing, workforce housing, student housing even, other types of sort of community development. And based on sort of that sampling size, I think it's a third sort of has a national goal, and then the 2/3 are sort of more regionally based. And so, as you might imagine, with anything, that's causing competition both for sort of good projects as well as sort of investors to put their money in. And not all QOFs are created equal, right? And so some have sort of very much more minded as to sort of the community development benefit, and are really trying to figure out how best to put money into a community that didn't have that access, maybe because it's, in a rural area that was neglected, or maybe just it just was sort of left out. And so many cities, counties, states, and I know PHFA as well, and Pennsylvania, are really trying to sort of become a clearinghouse as to sort of these are the zones, these are the projects that we know about, sort of, and to the extent that there are qualified opportunity funds, to try to woo them to the state and to invest in sort of where in their state.
Okay. So before we turn this over to Richard, I have a couple comments on funds. I would say buyer beware, because if you invest in a fund, basically these funds are put together, they're intermediaries, and they're looking at it as a way to aggregate capital and make money. I mean, quite frankly, they're unless it's a developer who's got a series of well thought out, well planned projects, and they form the fund for that. These groups are just aggregating capital, and you're going to have really relatively little control on where that capital goes. And if they don't deploy it on time, your IRR is going to get killed, and there's potential penalties. And at the end of the day, they got your capital, and they're going to make money. So it's really good if you're a fund owner, but I would prefer, if I was an investor, to have a single purpose fund investing in a single deal that I understood what is going to potentially provide in returns, and who the real sponsor is, and et cetera. So, I mean, buyer beware on the funds is my advice.
Okay.
So hopefully Richard doesn't have a fund he's putting together.
No. Good news. Wake back up. Hello.
Hey.
For the next 10 minutes, I will say nothing technical, and I'll show you pretty pictures as promised. So Rebecca had asked me to speak because Pennrose is obviously very active in development. We have about 50 projects in development today, representing about $2 billion, and of those, the vast majority are affordable. And therefore, my experiences with the affordable would relate to most people in this room today. About 100 of those deals that we've done to date, of the 250 or so, have been with community-based and nonprofit organizations. So I know also we have a lot of partners in the room today. So that's always nice to see as well. We also are one of the few developers that have closed OZ deals. We've closed 3 different OZ transactions to date, shown on the map here. One was a 100% affordable deal, the other was an 80-20, and the other was a straight-up market rate deal. So here's my perspective so far on this program. It will not make a bad deal a good deal. It will take a good deal and make it marginally better, and that's about it. It is not, the be-all and end-all. Virtually every deal that gets marketed to us today, somebody shows us a piece of property or a broker or whoever, if it's in an OZ, that is the only part of the story. That is the beginning and the end. Oh, it's OZ, it's OZ. But that really doesn't make, as I said, a good deal a bad deal. We started with this right after the program was initiated and paid attention right from the beginning, and tried to work this into some of our situations. And as time has gone by, and there's been much more hype about this, especially at the fund level, and you heard the number that was referenced, there's trillions of dollars out there of people who've got Apple stock that is appreciated, and they want to, anything they can do to sell that and not pay taxes on it, well, boy, that gets them all hyped up. So that has brought me to my second conclusion, which is that there will be more money lost by doing bad deals than will be saved in taxes. Because everybody's so motivated by saving those tax dollars that they're not looking at the underlying fundamentals of the deal. The concept of BlackRock or whoever raising $1 billion fund, or somebody doing $1 billion, all these funds that are out there, funds. The trick to this business is, I think, the SPE kind of situation that you just described, which is one fund equals one deal. That you should know, the investor knows who the deal is, who's the sponsor, what the returns are, et cetera, et cetera. And the third conclusion that I've sort of reached in regard to these OZs is probably the most depressing for people in this room, which is that there is not a lot of overlap between OZ and affordable housing. You would think that it would be a natural combination that would come together there. But immediately after the Tax Act was passed, I polled all of the major financial institutions that we do business with, which are most in the country. And all of them either came back with the answer, well, we don't have any capital gains to invest, or we're waiting for more regulations, or we're waiting for more clarity. And I kept pitching that, no, this is right down the center. We're not looking for raising a fund. We're doing exactly what we know we can get accomplished within the rules that are out there. And it just hasn't come to pass. To date, we have done one single deal that has had an OZ investment in a low-income housing tax credit deal, 100% low-income housing tax credit deal. And that was one of our financial partners that was looking at a deal, major financial institution, halfway through their due diligence, called up and said, holy cow, we actually do have some capital gains. And yeah, now we really want to do this deal because it's in an OZ. And there was a little bit of bump in the price, but nothing too crazy. So there was not, it was more motivated by their own capital gains than it was by some huge price increase that we got as a result of them putting money in the deal. So what is getting done? As I said, we've closed 3 deals that are opportunity zones, and we started a fund for each one of those, which has a single investor and a single project. So that's about the most straightforward that you can do. So that market rate deal I mentioned, and the low-income housing tax credit deal, which again, to date, there's not been a whole lot of action in. The 80-20 I wanted to run you through because I think that's where the action is. I think a mixed income property in which you're going to have true equity from some source, be it high net worth individual, be it family office, be it institutional, that's the type of deals that are going to make some sense. And for the people in this room, it's really those 80-20s and workforce housing deals. So I'll run you through one quickly. I promise to have some pretty pictures, right? So this was a development we did in New Brunswick, or underway now in New Brunswick. We demolished 2 existing theaters, performance theaters, and used that as our pad. It's right in the downtown of New Brunswick, so that was the original buildings that we demolished. You can see the center square right across the street. It's a very important intersection, kind of main and main on this deal. And this is what we're building. So we have a base at the bottom where we're replacing 2 of the theaters, one with 465 seats, one with 300 seats. Then we're doing 3 floors of offices. We're doing rehearsal space for the American Repertory Ballet, rehearsal space for the Mason Grove School of Performing Arts, and then we're doing a 650-car parking garage, a little less than that, 500-car parking garage, I think, and then 207 units of residential on top, and the 207 units are 80-20. And interesting on this deal, the 20% affordable is being targeted specifically to people working in the arts, which is kind of a cool thing, getting back to the theater idea. That's where it stands today. That picture is, obviously a couple months old, but that hoist is down, building's closed in and skinned, and it'll open in August. So any of these deals, of course, we had a whole pile of partners. Devco, who we've done a bunch of deals with, Middlesex County, our investors, our financial partners, just a myriad of folks. Nice, simple methodology to get to the closing in terms of how we acquired the property and what we did. And that actually, because it was so complicated, set us up to be able to use the opportunity zone. Because it had, this was happenstance that we, sort of stumbled in. Okay, we're in a good position. We can pull this off. So at the end of the deal, everybody gets back out to the ownership, and we end up with that residential component where Rutgers ends up with the office space, the theater ends up with its space, and the parking authority ends up with their space after we've master developed and built the whole thing. So that's what it looks like from a big capital source perspective, $171 million deal. And what really was this? Is this a thinger? Is that a laser pointer? Oh, it is. Cool. Nice. Oh, now I went too far. Now I did the wrong thing. Anyway, so forget the pointer. All right. In the yellow stack, the residential portion is where we use the OZ. We had need for about $15 million worth of private equity, and the deal was at a point where it was teetering. It didn't really make 100% sense. It was close, and that's where I get back to what I said before. It doesn't make a bad deal a good deal. It added just enough extra juice to put it over the top in order for us to be able to garner the resources in that residential component. We used a whole bunch of public money and public bonds in it, and you can imagine the documents and how happy we made Molly along the way. And then, of course, any good deal would not be complicated enough unless we threw in some new market tax credits. Thank you very much, Steve Berman, who shepherded all of this, by the way. Steve is over here, so if you have any technical questions about this deal, don't ask me. Steve Berman. So that was the new market tax credit piece, and then this is what the renderings of what it's going to look like when it's done. That's one of the performance theaters, the smaller black box, the larger, bigger piece, and the lobby, and residential lobby, great room lounge, et cetera, a little rooftop amenity space, and the top of the building there. So the bottom line and sort of the takeaway in my opinion, as it relates to OZs is, and again, for the people in this room, it's the workforce housing, it's the mixed income deals. That's where the opportunity really lies to throw this back in, because it's got to be a deal that requires real equity. And if you're doing a straight up 9% tax credit deal, the equity is going to come 100% from the sale of the low-income housing tax credits. There is no real equity in the game. And it's these other pieces that, in my mind, are these other types of developments that are the ones that make some sense. So I'll end there, and we can open it up for questions. And I was much quicker. Charlie, studying all night looking for the hard question. Go ahead.
Actually, this one just occurred to me. I know that the appreciation is exempt basically from year 1 to year 10. If you own a property for 15 years, is the appreciation between years 10 and 15 exempt, or does it stop at year 10?
Please repeat the question.
Oh, yeah.
Thank you, good memory.
Good, yeah. Good on you.
So the question is about that 10-year benefit we talked about, that any appreciation of the underlying asset, from year 1 to year 10, you get to basically ignore for tax purposes. What if you hold your interest in the QOF or in the structure for 15 years? Do you get to sort of exclude that? I think the test is that you have to hold your interest at least 10 years, and then at the time that you go to sell the QOF interest or the investor's interest in the QOF, or more recently, the possibility of selling the QOF's interest in the indirect entity if it was investing through a partnership or, a corporation, then it's at that point that you look at that during that period of the holding period that you've had it.
I'm gonna answer
and that's
that.
when you can, pardon?
I'm gonna shortchange that. Yes.
I was going to hook her too.
Yeah, if you hold
Okay,
on to
gentlemen.
it, if you hold on to it for longer than 10 years, the appreciation that you're going to get up till 2047.
2047.
Yeah.
Yeah.
All right.
Well,
no.
listen, I'll give the opinion.
Okay, if you want Richard's opinion.
So
If you want to see the real technical aspects of whether you can do that or not, better talk to the boss.
Yes or no?
yeah, so I do want to elaborate, so you can hook me if you want. But I indicated that a winner, low-income communities are winner, sponsors of projects are winners, but also people who want to hold property for a very long time. So family offices, people who want to have multi-generational wealth that they're maintaining, and this could be a good asset, component of it. To the idea that they can buy an asset and it appreciates all the way to 2047, and in the interim depreciate it down, and in the end with all the other components of tax reform. I mean, this is an amazing time to invest in real estate.
So
But for real estate, construction costs and all those other things, but from a tax perspective, with tax reform and what you can do with this component of code mashed up with other things, with writing off 100% of personal property and things like that in the next 3 or 4 years, those are all things that could be, structured into these transactions and benefit sponsors of projects.
That certainly has been our experience to date. It's ultra-high net worth, generational, multi-generational family offices that also have somebody who understands urban real estate. So it's the confluence of those two things. One of our investors came into an awful lot of money and was born and raised in Detroit in a tougher neighborhood, gets it, understands the whole program, and that's what he wants to put his money back into. And the concept of saving taxes along the way is great, too. Please.
So Molly, you mentioned you're working with several funds, and a lot of funds that I have run into have been more institutional and larger in nature. The deal that you mentioned is $172 million. In the middle market space of like these $12 to $20 million deals, are we seeing funds that are dealing with deals of that size, or is it just we're still emerging markets and
I don't want to interrupt you again.
adapting to the market?
So I've been tasked with repeating the question and not interrupting. So
And talking to me at the same time that she's
correct. So the question was, a lot of these funds are talking about a lot of money, raising $200 million at a clip or $1 billion or whatever. And is there a market, and have people been pursuing deals that are more in the $5 to $15 or $20 million worth of equity need?
And my experience, and I would say that this is, anecdotal, but, there is somewhat of a sweet spot, and I think it also depends on sort of what the need is. So when my first engagement was with a real estate developer that had this need, and so, he was looking to friends and family, friends and family of friends and family, and sort of that was a smaller QOF that had a very direct, and then sort of working with family offices that have, I have this real estate strategy I want to employ, and, maybe I have, 30 million of capital gains that I want to put in, and I want to do this over, several different deals, not one. So there's no one flavor here. I think it's multiple ones. Those funds that are like the 500 million, the billion, those huge, eye-popping numbers, certainly in order to make that work, you're not going to get there by putting, $2 million of equity in. And, that's a great time to mention, too, the transaction costs, because there is a bit more complexity, and there's also a bit more of accounting and sort of financial consulting costs built in, because we're testing that we're eligible, the business is eligible over that at least 10-year period of time. This has to be a certain size of deal. The QOF equity won't be the other source. That's the other thing, getting lenders sort of used to this. But from their perspective, in many respects, it's just more equity, right? They might not know. Like, I don't know if the lenders in your deal knew that, the LIHTC investor was also getting the QOF benefit. It's at the end of the day, it's resulting in, a certain amount of equity. So I also would say, too, that it's going to evolve. Right now that there is more guidance, I think there'll be more sort of institutionalizing this and in a way that perhaps might be a little bit more practical. So we'll see.
I'm very much in favor of the practical. I mean, at the end of the day, this is not like a new market transactions or a LIHTC transaction. It's private parties, a lawyer, an accountant. They don't have to, it can be done pretty efficiently, even for really small. So if you have a small business and they're raising money from friends and family to buy a building, it could be set up structurally so that the test will just pass automatically every year. So it's really good for accountants and investment bankers to put together transactions.
What do you think the sweet spot is for the funds that you are seeing that are out there and, trying to put money on the street?
So the question is, what is the sweet spot?
Took away my job.
Pardon?
Well, first
Took
off,
away my job of repeating the question, but
Oh,
okay.
I'm sorry.
that's right.
I guess it's clear enough.
Yeah. The question is, first off, do they even have the funds? They say they're putting together a fund. They say they have commitments, but when you actually ask them and get behind it, they actually don't have the capital. They might have some soft commitments, but the people haven't forked over the cash in many circumstances.
So a fund, just anecdotally, a fund I'm working with now, it has two institutional investors. They're one's putting in about 20 million, the other's putting in about, 30 million, and then they're going to, invest that in like 4 or 5 projects. That's sort of their model, and that I will say, I think it's been mentioned that some of the typical sort of LIHTC funds and LIHTC syndicators may not necessarily be jumping into this, but some are, and some are not just for LIHTC, but perhaps for workforce housing, or perhaps for the 80/20s, or some other sort of element that it's affordable, but it's not, necessarily LIHTC. Lots of interest in, housing authorities too, like how can we mobilize, we've got a big, portfolio of our units, the sort of what that might need rehab. Is this a, potential way that we can use that? So I think people are sort of using it, and then, but, as to the sweet spot, I think that's evolving, and I think it's evolving in terms of the asset class too. So, for example, with affordable housing, there might be one answer to that, and, for something else like hotels, it might be something different.
Please.
Yes, sir.
We're a nonprofit, we already acquired property prior to that 2017 date. Is that a deal breaker?
So the question is, nonprofit sponsor acquires property prior to 2017. Is it still eligible?
So that's a tricky question. I will say that, as we said, that qualified opportunity zone business property is acquired by purchase after 12/31/2017, but we didn't go through, but when I mentioned there are, 5 instances of the word substantial or substantially all, and we have a 90% asset test, and there's also this 70% substantial test. It's very facts and circumstances, but with a lot of sort of numbers and a lot of discussion, there could be a situation where that might qualify, but that's not a slam dunk, and that's not an easy answer. You're wedging yourself into these various requirements because a lot of them aren't 100%, but they have to all fit together, so you have to see whether that could potentially work.
Seek guidance from qualified counsel.
We're working with a lot of groups who have property in that circumstance, and they're either selling it to the new entity and then just following and making sure they're following the related party rules. There's many different
Which is
options.
20%.
Yeah.
So the commonality between if you're going to sell it to somebody that you want to participate in that owner entity, the buying entity, you're limited to 20%. And
Right.
it gets tricky too with carried interest, right? And
Yep.
some of the promote and some of so it has to be very carefully considered.
Yeah. Seek qualified counsel.
You pick.
Yes, sir.
What could be the community benefits for a property using OZ?
So I'll start, and that's really where, from my perspective, the community organizations, nonprofits really have to be the sort of stewards looking out for this. But in theory, right, the project is renovated or sort of built, and it's going to do something to the community. So the job growth, perhaps a reduction of poverty in that area, depending upon that asset. Perhaps it's somewhat akin to new markets. Is it providing a catalyst for other economic development in that area? It might be sort of, the first one on the block that then sort of has a domino effect. But that's where I think what will be so interesting is to see how it develops in terms of what the requirements of these measurements are, and really the investors, if there is, because this is a program that I think is so diverse in many ways. It's not like there are 5 institutions that are really directing the market. I think it's much broader, but big investors, quite frankly, if they're requiring certain effects, then that sometimes does, make the market that way.
Is there any criteria within the program right now that speak to project magnitude periods that we all use? So are there any consideration for local vendor or this small business to be able to participate?
Not 100% on the question, except I think I heard you say that is there a union requirement, and is there a requirement to hire small and locally based community vendors?
This is correction, that because of the size of the project, it is going to be
Because of the size?
dollar-wise.
I don't think that's, I think you can do any size project. This happened to be a big one, but there are deals that we're doing that are very much smaller. So, No comment and moving on.
Okay, so I will answer that question a little bit more direct. There are no requirements to provide any community benefits under this program. It is
Today.
not a
Today.
program. It is,
Today.
no, well,
Today.
there may be reporting requirements, but if you have no impact, that's what you report.
That's
And at
true.
the end of the
That
day,
is
if
true.
Congress provides reporting impact, this doesn't mean it's going to be impact. This is not a program. This is a tax benefit.
There's not a competitive process to
Yes.
have the
Right.
eligibility for it.
Right, right.
The real question is this: will too many developments get done that don't provide any significant level of benefit in affluent areas that were otherwise going to be done anyway, and the program therefore get killed before many good projects get done that provide important benefits to communities utilizing this program? That's really the question that's out there.
We have time for one or
One
more
more-
questions?
one more question.
Yeah.
Do you see the 10-year investment return kind of being a hindrance to attracting opportunity zone funds in census tracts that might not have the same optimistic investment horizons? So say like a rural steel town in Pittsburgh versus an area in the city that's already got capital improvements that's moving towards what is revitalization. And are there any mission-based funds or your thoughts on that?
I think that was loud enough for everybody to hear.
For the recording too. Are there mission-based funds?
Yeah,
I think,
are there any mission-based funds and the comparative analysis between rural, Rust Belt versus emerging, sort of growth neighborhoods? Is that sort of?
Yeah, I don't think I'll take that question. There are mission-based groups working on this program, and a lot of these deals, they are in new market zones. They are in zones where the county and the state want things to happen, so other resources will come into these transactions that may be able to provide the enhancement to the returns to make them happen. So in Richard's example, he used new markets. Well, new markets had requirements that they had to have community benefits and things like that. But I think there will be a bias, and frankly, probably against the rural transactions because they don't maybe have as many resources as the urban areas, to draw from. They may get a USDA direct loan, and there may be other things that maybe get in the way of maybe shrinking the amount of equity that goes into those transactions. I think this will. It remains to be seen whether the rural projects will be able to attract enough investment.
Back to my original quote. It does not make a deal that doesn't make any sense suddenly makes sense. So if it's a deal that was close, or if there are other resources that can be brought to bear, and I think that's what Mike is referring to. So a deal that, this may be one component of many. Add to it new market tax credits. Throw in some other governmental funds that are driven towards workforce housing or targeted AMIs, and then I think it's an additional tool in the toolbox.
And then the localities may provide additional benefits too,
Yeah.
alongside that, in terms of tax abatements or what have you.
Yep.
So I see our time is up, unfortunately. I think we'll be around if anybody else has any questions, but thank you so much for your interest, and we appreciate your time.
Thank you. Good job.